Okay, so let's start our class. Ifrs 16. So we'll finish this next week. Ifrs 16 on leases. Leases. Now, you see, what we want to look at today when it comes to Ifrs 16 is basically situations whereby organizations are able to buy assets, majorly non-current assets like PPE, or maybe even investment property, and they're able to buy it in such a way that they don't have to pay the entire money immediately. So they can just drop a deposit, then they will pay the remaining money over so many years. So in such a way, they are still able to continue with their economic activity while not putting down so much money. So that type of arrangement is what we want to look at today. You need an asset, but you don't have to put down the entire money. So the first thing we would look at naturally is what is a lease according to IFRS 16. What is a lease? So IFRS 16 said that a lease, he said, is a contract or part of a contract that conveys the right to use an asset for a period in exchange for a consideration. So IFRS 16 said that a lease is a contract or part of a contract that conveys the right to use an asset for a period in exchange for a consideration. The first thing in this definition shows that a lease is a contract, just similar to what we learned under financial instruments and also IFRS 15 on revenue. Those two are also contracts. A lease as well is a contract in the sense that before we can say a transaction is a lease, a contract must be consummated. And by now, you know that a contract is an agreement that has enforceable rights and obligation. An agreement that is enforceable by law. And you know now that it doesn't necessarily have to be in writing. It's just an understanding that is enforceable. So, a contract. A lease could just be part of a contract in the sense that in a whole contract, there might be other non-lease components. A contract might deal with other items beyond lease. So a lease might just be part of it. We'll look at the scenario to take care of this. And this contract, it conveys the right to use an asset, which means that a party who is usually the owner of the asset transfers the right to use that asset, which is the underlying asset that we are talking about, of course, to another party for a period. It's always for a specified period. And of course, in exchange for a what? The guy will have to pay periodically. Now, since there is a contract, there have to be at least two parties. The party who is the owner of the assets, whom we can call the landlord, Abi, we call that party the lessor. And the party who is now using the asset, or who now have the right to use the assets, who is the tenant, we can call that party a lessee. So we have a lessor and a lessee. This is what a lease is. And our focus today is how do we account for it? IFRS 16 has changed a lot of accounting for leases, which we are going to see pretty soon. Very different from what we used to have under IAS 17. Now, in accounting for this, the first important item we need to identify is how do you even identify a lease in a contract? How do you identify a lease in a contract? So let's look at identifying a lease. Is this fan okay? Okay. Identifying a lease. Let's look at how we identify a lease in a contract. Now, when you pick a contract, we need to be able to know whether there is a lease in that contract. And the way we know it is if the party that we call the lessee, that is not the owner of the assets, if he has rights of control, if he has right of control, or maybe right to control the use of the asset, then you should know that there is a lease in this contract. And when we say right of control, it means that that party that is not the owner of the asset, who is the lessee, he has right to obtain substantially all the economic benefits, attributable to the assets. And number two, he has rights to direct the use of the asset. This too shows right of control. Where the lessee, who is not the owner of the asset, only has right to use of the asset, where the lessee has right to obtain substantially all the economic benefit attributable to the assets, and also right to direct the use of the asset. That is right of control. When somebody that does not own the asset has this right of control, then there is a lease in that contract. And how will somebody have right to obtain substantially all the economic benefit attributable to the asset? Is if that person is the sole user of that asset. He's the only one using it for his economic activities. Then he is the one that will obtain substantially all the economic benefits attributable to the asset. And two is right to direct the use. If it is the lessee that is making decision on the usage of the asset, on how we want to use the asset, then of course, it shows that he has right of control. You see, for these two to exist, for us to be able to determine right of control, which is these two, very importantly, from these two, we must be able to identify the assets. There must be a specified asset. There must be a what? There must be a specified asset. Because we must be able to pinpoint down to a particular asset that we have transferred the right of use, or a particular asset that the lessee has right of control. A specified asset. Because if you don't have a specified asset, we won't be able to say that, okay, he's the only one using this asset. He's directing the use of this asset. There must be a specified asset. And number two is that the lessor The lessor cannot substitute the asset. The lessor cannot substitute the assets. The lessor cannot substitute it. So the lessor cannot come and say, I want to change this asset. Why don't you take this? Let me have the one you are using. No, he should not be able to substitute the asset. If he can, then that means the lease has been broken. Except if that substitution is probably because the asset has been damaged and needs to be repaired. Except if the asset has been damaged and needs to be repaired, then maybe you can substitute. But ordinarily, we should not be able to substitute the asset. So all these are indicators that there is a lease in a contract. Now, very quickly, let's open our handout and solve like 2 or 3 questions to understand how you identify a lease in a contract. Let's go to, okay, that's the first page of the handout. 2.1.
BDO Transport Company entered into a 3-year contract with CML, under which CML supplies BDO with 5 luxurious buses for the purpose of interstate transport. CML owns the entire 5 buses specified in the contract. BDO determines the routes taken for the interstate transport as well as the pricing. BDO can choose the use of the buses for the purposes other than the interstate transport. When the buses are not being used, they are kept at the premises of BDO and cannot be retrieved by CML unless BDO defaults on the payment. If the buses need to be serviced or repaired, CML is obligated to provide a temporary replacement for the same type of buses required. Determine whether the above contract is a lease contract.
Okay, so the question asks us to determine whether the contract is a lease contract. And when you look at the question, you will see that BDO is the lessee, while CML is the lessor, because it's CML that is supplying the buses. And I can see here that CML supplied BDO with 5 luxurious buses. That one is very important because that shows that there is a specified asset, there is an identified asset. That is extremely important. So when we identify that there is a specific asset, then we can then go ahead and check if BDO has right of control. Let's check. Then they went ahead and said that CML owns the entire 5 buses specified in the contract. They said BDO determines the routes taken for the interstate transport as well as the pricing. That sentence shows that BDO has right to direct the use of the asset. Then they went ahead to say that BDO can choose to use the buses for purposes other than the interstate transport. That also further shows that BDO has right to direct the use of the what? Of the asset, because he's the one deciding how he wants to use these assets. Then they went ahead. They said when the buses are not being used, they are kept at the premises of BDO and cannot be retrieved by CML unless BDO defaults on payments. What this shows is that BDO is the only one using this asset because CML cannot retrieve it for whatever reason. What that shows us is that BDO has right to substantially or to obtain substantially all the economic benefit because he's the only one using it. Nobody else, no one else except him. And finally, they said if the buses need to be serviced or repaired, CML is obliged to provide a temporary replacement of the same type of bus. That will not affect our decision because they said that CML can substitute if there is need for repair or service. That one is okay. Even though we said that the lessor cannot substitute the asset. But we said it can actually do that if there is need for repair or service. So it's okay. From all these points above, it shows clearly that there is a lease in this contract because the lessee, who is BDO, has right to obtain substantially all the economic benefit on this asset and also has right to direct the use of this asset. The solution is there in the handout for you. Let's go to the second one.
BDO Transport Limited has recently made substantial cuts to its interstate transport service. It will now provide such services only in case of great need. It has entered into a 2-year contract with CML for the use of one of its luxurious buses for the interstate transport. The luxurious bus must seat 45 people, but CML can only use any of its 45-seater luxurious buses when required. The luxurious buses are held on CML premises and are only made available to BDO on request. Determine whether the above contract is a lease contract.
Look up. So from this question again, you see that now BDO, who is the lessee, he has made a recent cut in his interstate transport service, and it will now provide such service only in cases of great need. He now said that he entered into a 2-year contract with CML for the use of its luxurious, for the use of one of its luxurious buses. That sentence shows me clearly that there is no identified asset here. There is no specified asset here. They can't tell us one of its luxurious. No, we need to be able to pinpoint to a particular bus or buses that he uses alone. But in this case, one of his luxurious buses. That is telling me that this might not meet right of control. But let's continue. He now said that the luxurious bus must seat 45 people, but CML can use any of its 45-seater luxurious buses when required. This shows me clearly that CML is also using that bus. That means BDO is not the only one using it, which shows that he's not obtaining substantially all the economic benefit because he's not the only one using it. They now said the luxurious buses are held on CML premises and are only made available to BDO on request. This doesn't affect our decision because whose premises the bus is not important here in making our decision of right of control. What is important is who is using it, not whose premises it is. It can be in the premises of CML and CML is not using it. But in this case, it's in the premises of BDL, CML, and BDO can request when it needs. It's okay. It's okay. But CML is obviously using it. So this indicates that there is no lease in this contract. There is no lease in this contract. Let's go to the third one.
Wespa enters into a 10-year contract with a telecom company for the right to use 3 specified physical dark fibers within a large fiber optic cable connecting Osun to Ibadan. WASPA makes the decisions about the use of the fibers, but connecting each end of the fibers to its electronic equipment. WASPA powers the fibers and decides what data and how much data those fibers will transport. Required, determine whether the above contract is a lease contract.
Okay. From your experience now, is this a lease contract or not? Yes, it is. It is a lease contract. Because from what we can see here, there is a specified asset, which is the dark fiber optic cable. And WASPA, who is the lessee, He's the one deciding how to use the fiber. Whatever it is he wants to do with it, he's the one deciding it. And that was it. And there's no indication here that shows that the telecom company is also using it. So there's right of control. There's a lease in this contract. Okay, and like that. So that is what we mean by right of control. Now, you see, when we have a lease or when we have a contract, a lease could just be just part of that contract. In the sense that in the same contract, we could have non-lease components in the same contract. So you might be given a scenario like that where a lease is just part of it and they will hide it in such a way that you will not see it. And the examiner will ask you to analyze and discuss whether there is a lease in this contract. Okay? And of course, those kind of questions will come in form of 7 or 8 marks. And what will have given you 3 or 4 marks will be this principle here. Everything here will give you 3 or 4 marks. The ability to say that for us to identify that there is a lease in the contract, there must be right of what? Control. Then you state the benefit, the right to direct the use, identified asset, and cannot substitute. Those ones, when you state those ones, you now go to the case and see if there is a person that does not own an asset that has right of control. If that is present, that means there is a lease in that what? In that contract. You see, those type of contract, they call it a contract with multiple components. Okay? Where there is a lease as part of it. Let's look at a scenario like that and see if we can identify the lease in the contract. That's question 2.5.
Under a 4-year arrangement, a car seat wholesaler buys its seats from a manufacturer. Under the terms of the agreement, car seat license its know-how to manufacture royalty-free to allow it to construct a machine capable of manufacturing the car seats to car seat specifications. Ownership of the know-how remains with car seats and the machine has an economic life of 4 years. Car seat pays an amount per car seat pays an amount per car seat produced by manufac. However, the arrangement states that a minimum payment will be guaranteed each year to allow manufac to recover the cost of its investment in the machinery. The arrangement states that the machinery cannot be used to make seats for other customers of manufac, and the car seat can purchase the machinery at any time in brackets at the price equivalent to the minimum guaranteed payment not yet paid required. Is there a lease in this arrangement agreement?
Okay. So this question is also asking us whether there is a lease in these arrangements. And when you look at this question, looking at the first paragraph or the first sentence, you see that there is a 4-year agreement that a car seat wholesaler car seats buy its seats from a manufacturer manufac. Judging by this first sentence alone, there is nothing like lease. Abi? It's just a buyer buying from a seller. Let's go to the second paragraph. They said, under the terms of the agreement, he said that the car seat licenses its what? Its know-how to whom? Royalty free. To allow you to construct a machine capable of manufacturing the car seat to car seat specification. Now, what this second sentence is saying is that the car seat has a skill, it has a technology, it has a know-how on how a machine can be manufactured. And he wants manufac to manufacture that machine in that way. And he's ready to tell manufac how to do that for free. What is important is manufac to just manufacture the what? Machine. And of course, he's fighting for his own interest. because there's a way he wants that car seat to be manufactured that only that machine can do it that way. And that's what that sentence is talking about. That's not indicative of anything yet. They now said that ownership of the know-how remains with car seats, and the machine has an economic life of how many years?
4 years.
So obviously, that means that manufacturer agreed and he manufactured that what? That machine. And it's going to have a useful life for how many years? But who will own this machine in question? Who will own this machine? Who manufactured the machine? Who owns the machine? How will I manufacture a machine? It will not be you that will own it. Show me I'm your servant. Ne? And so they said it's free. I did not ask him to tell me. He's the one that volunteered for his own benefit that he will tell me how to manufacture a machine. I'm not invested. I manufactured a machine. You're not coming with your own. No, there's nothing indicating there that says it's from car seat. Obviously, it's for manufacture. He's the one that will have invested. Even though that's why they said the car seat gave him a know-how, royalty free. That I will show you how to manufacture this machine. It's free. I'm not charging you anything. You just go and manufacture it. So, what the second paragraph, what we can pick here is that there is now a machine that has been manufactured. Now, that's what we can pick here. The issue of know-how has no significance here because it's free. Okay? So, there is a machine. Now, let's go to the third paragraph. It says that the car seat pays an amount per car seat produced by manufacturer. However, the agreement states that a minimum payment will be guaranteed each year to allow manufacturer to recover the cost of his investments in the machinery. So of course, when the machine is now ready, the guy is still car seat is still paying for those seats normally, but they have now added something on top of what he's paying, just so that manufacturer could be able to recover his investments in that machine. They added something on top, a minimum payment, just so that the guy can recover the investments he has made on the machine. So that's what this one is still talking about, right? So they have added some money on top of the purchase price just to help manufacturer recover his investment on the machine. Next paragraph. The agreement states that the machinery cannot be used to make seats for other customers of manufacturer, and car seat can purchase the machinery at any time, equivalent to the minimum price, the unpaid guaranteed minimum price. So, what this last paragraph is telling me is that that machine is only being used for car seats. Not that manufacturer does not have other customers, but as far as that machine is concerned, it's like they have dedicated it to car seat alone. So now, from this scenario now, is there a lease in this contract? Okay, prove it.
He only has one of the companies.
Eh?
He only has one of the characteristics of the lease.
Which is what?
Identified assets.
Identified asset. If that's the only one, then there is no lease. There is no lease. Because when there's identified asset, the person that is not the owner of that asset, you must be able to prove that that person has right of control.
But if the machine, the seat that was produced by that machine, will be used only by the car seat, so that means that the free one of the obligation that the economic that right to obtain substantially all the economic benefits derived from the asset. So this is made initially for him to use. So that has to do that particular way. Then right to to direct the use of the asset. So since the contract that the machine was designed specifically for him and him alone for that car,
But it's not doing that.
that he has the right now, since there's no indication here that shows that manufacturer can also use it. So has met those two criteria that he solely has the right to control and direct the and see that.
I mean, I agree with him. I agree with him. So here now, there's an identified asset. There's a machine that's manufactured. Now, then the question is, who has right of control on the machine? Obviously, it's Cassette, because how the machine was even manufactured, what it will be used for, is dictated by Cassette. That's directing the use. That's directing the use. And secondly, is that machine is even used for him alone. No one else is using it. They are using it for his benefit alone. That means, as far as benefit from these assets, it's Cassette that is obtaining substantially all the economic benefit from these assets. So it has actually met these two. So Cassette, who is the lessee, who is not the owner of the assets, has right of control. There is a lease in this contract. Okay? So there is a lease in this contract. Just that there is also a non-lease too. There is also a non, which is the fact that he's buying. Yeah. So usually, this one is a bit easy to split. Split in the sense that the money that Cassette is paying, we can easily split it into the purchase price and the lease rental, because they have told us that they have added something on top. That something on top they added is the lease rental. Why the remaining is the normal purchase. So what our focus today is not how to treat the normal purchase price. Our focus is that lease rental. How do you treat it in the books? That's the focus of today's class, which is what we're going to attend to very soon. Okay, so fantastic. Now, what we have covered so far is just understanding lease in a contract and lease being part of a contract. Now, the next thing is lease term. Remember, I told you that a lease is always for a period of time. This period of time, we call it lease term. And this lease term, we believe, for the purpose of accounting for it, it should be non-cancelable. It should be a what? It should be a non-cancelable period. It's not a period that will just come and say you want to cancel. It should be a non-cancelable period. This lease term, even though a contract can specify the termination clause, but for the purpose of accounting for leases, we assume that this lease term is a what? Non-cancelable. It's a period that should start and end. You should not cancel it in between. A non-cancelable period. Of course, over which the lessee has right to what? Use this asset. However, there is a possibility that this lease term can be extended. It can be what? Extended. Now, that period of extension, are we going to consider it as part of the lease term? It depends. It depends on whether that period of extension is favorable or unfavorable to the lessee. If that period of extension is favorable to the lessee, then you will consider it. So if the examiner tells you that the non-cancelable period is 5 years and it can be extended by another what? 2 years. They need to tell us whether this extending by 2 years is favorable or not. We have to be told. If they are silent, if they don't tell us, that means we are not going to consider this period of extension. If they are just silent, they just say it can extend. We will not consider it as part of the lease term. But if the examiner gives us a clue, like the question we have in your part, they told us that the initial lease period was, I think, 5 years, and the guy was paying 10,000 naira per annum during that 5 years period as rent, and they were now told that he can extend for additional 3 years, and this additional 3 years is going to be paying 15 naira per annum. That is highly favorable. They don't have to tell you that this is favorable before you know. Somebody that was paying 10,000 naira before, now is going to be paying how much? 15 naira. That is favorable for him. So in that case, the lease term is going to be the original lease term, which is 5 years, and also the extended period. Okay? So we need to be sure that the lessee will exercise that option to extend. If he's going to exercise it, we'll consider it as part of the what? As part of the lease term. Of course, since there is extension, there might be a clause that will terminate, that we might terminate before the end. It's possible, but are you going to consider that or not? Mostly, you will not worry about that because they have told us that it should be a what? A non-cancelable period. So if they tell us that we can terminate at this point, at this event, you will just consider just the original lease what? Lease period. Except if they now tell us that the lessee will terminate. If I've not seen a question like that before, but have it in mind. If at the inception of the lease, the lessee knows that he will exercise the option of terminating. So if the lease term is 5 years, and they say it can terminate within 3 years, that means the lease term will consider to be how many years? Just 3 years. If they tell us that he will exercise that option, then just consider the lease period as how much? As 3 years. But we have not really seen that situation. The situation you most likely find in your exam is where there is extension. That's the common one we will find. Okay, that's lease term. Now let's now go to why we are here. Of course, this is also important as well. Is how to account for this. So when it comes to leases, yes, the journal entries. When it comes to leases, there are two parties involved, lessee and the lessor. So let's see if you can cover the two today, maybe likely, maybe not likely. If you can cover the two today, then next week we'll just come here and do sales and lease back. Then we'll be done with leases. Probably I will introduce you to IS 21. Then we'll solve that last diet question that they asked, that question one. But that question one is, like I've told you, is way beyond IS 21, is core application of accounting standards. I'll be glad to solve it with you next or per week before we then go to other areas of your syllabus. So now let's go to accounting for lease. I'll start with the lessee accounting. Let me start with the lessee accounting. Okay, let's see. The guy that has the right to use the tenant, Abi, how does he account for the lease, considering the fact that he's the one using this asset? So, IFRS 16 says that at the commencement date, he said the lessee would recognize a lease liability and also a right of use asset ROU. It will recognize a lease liability and a right of use asset. This is simply saying that the lessee will credit a lease liability and it will debit a what? A right of use asset. That is what it does at the commencement date of the lease. Now, the key question is how much? How much is it going to debit? How much is it going to credit? How much? Very straightforward. Let's assume that there is a 5 years lease and it's paying 10,000 per annum as lease rental. There is a 5-year lease and it's paying 10,000 naira per annum as lease rental. In this case now, at the commencement date, how much do you think it will debit as liability and how much will it credit as liability? How much will it debit as right of use asset? 50,000. Okay? You were saying something? Per year, yeah. The present value of each year, he says 50,000. He says the present value of the 50,000, okay, for each year. Okay, since it's equal amount every year, probably you're saying you will use annuity. Okay, any other one? Well, that's fantastic. So he is correct, really, but his answer also is very logical. For the fact that he was able to say 50, that shows me that I understand what he's talking about. That as of today, what this lessee is owing is 50,000. And that is what we should recognize as liability. But in reporting, we do not recognize future value. Any future payment that surpasses 1 year, you don't recognize that gross amount anymore. We discount it to present value. Even remember in IFRS 15, I told you that under step 3, transaction price is usually affected by time value of money. We discount it to present value. The same, yeah. So we will not recognize 50,000 gross, but rather it will be the present value of that what? Of that amount. But please ask.
Okay, Mr. Jekede already spoke to Lagos State government and already a lot of 100,000 naira of bridge credit system for a year, for 3 years.
Okay.
Yeah, for 3 years. And the payment amount is 7,416 naira,
Every year,
every month.
every month.
Until you pay back the loan.
Mm-hmm.
So is this like this one is
Okay, so lease has to do with collecting assets, not money. Okay, that's a collected money. So that's like a financial liability. Okay, so leases is a collected asset, not money. Okay, so how do we get the present value of this? Assuming they gave us a discount rate of 10%. How do you get the present value of this 10,000 naira per annum? Assuming they gave us 10%, I assume you should know this. Use annuity factor. What's the formula for annuity factor? Okay. Can you give me the answer if it's 10%? Sorry? 3.7. You now multiply by what? By 10,000. 37,908. Okay. So usually, definitely it would be because you have discounted it to present value. So it's the same thing like saying that the value of 37,908 today is equivalent to 50,000 in the next 5 years. Or, I mean, 10,000 if we spread it over. So the value of money today is always higher, probably because of inflation that will have eroded the value of the currency over time. Okay, so in the exam, usually they will give you this figure in the exam. Fina- Reporting exam, I mean, we're not really bothered about testing how to do a native factor. That's not our own concern. Let SFM deal with those ones and whatever. Ours is how do you know how to account for these things? So the examiner will give you, yeah, they will give you the present value of whatever you need and account for it. So what is important is for you to know that this present value, you use it to debit your right of use assets, and you also use it to credit your what? That's the first thing I need you to know very well here. Then, from here now, what I've said in essence is that when you have a lease liability at the commencement date, it is measured at what? At the present value of what? Of the unpaid lease rentals per annum, abi? Because you need to be very careful. What if they told us that the guy pays 10,000 as deposit? If he pays 10,000 as deposit, you will not get 3.791 again because this N is not going to be 5, it will be 4. So the present value you are doing is the present value of what? Unpaid lease rental per annum at the commencement date. Oh. In fact, let me put it there. At the what? At the commencement date. That is it for lease liability. But let me now assume this lease rental of 10,000. This lease rental of 10,000, a lot of things can happen to it, even though it's not really so much of our concern. But I just need to tell you that a lot of things are embedded in it. Number one is this: they will have considered the possibility of, of a variable or changes in this lease rental. If that will be factored in, they will have found a way when you're accounting for it. Because if you don't account for it, that's those changes that could happen in between, it will be difficult when you have gotten present value already. It will be very difficult because your account is not going to jive at the end of the day. So if there will be any variable effects as a result of increment or whatever, you must have factored it in. Also, there's something we call guaranteed residual value. There's something we call what? Everybody here knows what a residual value is. It's usually the value of an asset at the end of its useful life, which we call scrap value. Usually, a lessee will guarantee a lessor a residual value. Just telling the lessor that I will not misuse your asset, I'm assuring you that after this lease term, this asset will still be worth this amount. Usually the lessor will not believe him and say, okay, if you are so sure, why don't we add it to your rent? So that in case things doesn't go as planned, I will know that I did not lose. So in all situations, except where it is specifically stated, this guaranteed residual value will have been factored in. So will have been what? If they don't factor it in, you need to factor it in. That's if they give you separately. Because it should be considered today. We don't wait till that time. So if there is any guarantee, because it's guaranteed. So if the guy has guaranteed, we expect it that you factor it as part of your liability today. You factor it in. And also, if the agreement states that there will be purchase option, if the agreement says that there will be what? A purchase option is where the lessee has rights to buy the assets at the end of the lease term at, of course, a small amount. He has the right already. So that also, that money is going to pay at the end of the lease term should also be one way or the other considered when determining this lease rental. They will have also considered it so that at the end, the asset will just become his own. It will just become his own. They won't start arguing about, because we already know how much you are going to what. So just add it to the lease renter, add it to your liability today, and you pay it all over. So this liability, we consider any variable elements. We consider uh, guaranteed residual what? Residual value. What do we consider again? We consider purchase option. And in most cases, which is this, the simpler one, is just a fixed amount. So these four elements are usually factored in the what? In the lease rentals. They are always factored in the lease rentals. So they will have easily affected your lease liability. It can affect it. So I'm just saying that because I won't mention it again. That's why I just want you to know in case you find it in the exam, you won't be surprised. Okay, that is at the beginning of the year. So what happens at the end of the year to the lease liability? What happened at the end of the year? So at the end of the year, we call it subsequent measurement. Abi? So at the end of the year, you are going to increase the lease liability with what? With interest. At the end of the year, you will increase the lease liability with what? With interest. And also reduce the lease liability with lease rentals. Increase the lease liability with interest and reduce the lease liability with lease rentals. That is what you do at the end of every year. At the end of every year until you settle out. So let me jog your mind a bit. Let me jog your mind a bit. We said increase the lease liability with interest. Why? Why are you increasing the lease liability with interest? Why are we increasing the lease liability with interest? Why are we increasing, why are we adding interest ourselves to our liability? Any idea? Okay, tell me. Okay.
Right from
Okay, so they might have said it will pay interest. No, they won't say that. Yeah. So they won't say that. I've never find that in a contract before. Okay. Okay. I mean, he has answered it. It's because of the present value. We are unwinding the discount. It's because of time value of money. So anytime we present value, as you move through time, if at the end of every year, you unwind it. You know that he was asking that it's 50,000 in the future now. He said 7,000 now because it's present value. So we want to do it in such a way that when we get to that future, it should be 50. Yes, through interest. Because that's time value of money, anyways, right? So through interest. So at the end of every year now, we will do 10% of this 37,000. That 3,000 something, you add it. So that one too, next year, you do interest, you add it. If you do that, at the end of the fifth year, it becomes 50,000. So everything zeroes out. So that's why we are increasing the lease liability with what? Interest. Just to take care of the time value of money, unwinding the discount. If I may ask, what's the double entry for that? What's the double entry for this? What's the double entry for this? That's correct. With a finance cost, Abi, or interest. That's correct. It goes to POL. If the taxman sees this amount in your POL, for you that are doing tax, will they allow it? Will they allow it? Is there nobody in practice here? Is there nobody in practice here? Would they allow it? So the tax man doesn't like it. The guy doesn't like it. He would say that is this something you ever pay? The guy doesn't want time. What does he would disallow it? Yes, it's a notional interest. He would never allow it. But we know, but we will not agree. We will not agree. We will use a boju. So the taxman must know his work. He must be good. Otherwise, he will say, hey, why now? Now, IFRS 16 says you recognize this. Yes. He said, Ginigon, no, you have to allow this. Ginigon, you fine, fine. If the guy knows his onions, he would, but mostly we would use Ogboji. The guy will allow it eventually. Then we will just be looking. But ordinarily, looking at the taxation principle, the guy should just simply disallow it. Right? That is for this. Now, the next one, this is not surprising because the rent you are paying every year is what will ultimately be reducing your liability every year. Abi? So that is okay. What's the double entry for this? Because of double entry. What's the double entry for this? You what? You debit lease liability. Why? Thank you. Nice one. Nice one. Nice one. Because it's reducing your liability, you debit. Fantastic. I like your starting point. Because it's reducing anything reduces my liability debits. What do you credit? Bank. Bank. You see, I'm doing this intentionally because you're accountant, right? you will qualify. You need to be very good with double entry. So that they will not be asking you that, but you say you're an accountant. Okay, this is it for liability. Now, the second one, which is what? Right of use assets. We have already established the fact that at initial measurement, you would debit the right of use and credit the liability with the present value of the unpaid lease rentals. Abi? So the same thing happens here too. It is initially measured. It is initially measured at what? At the present value of what? At commencement date, Abi? But the right of use does not stop there, because the right of use would consider any amount paid at the commencement date. It will consider what? Amount paid at when? Amount paid at the commencement date. And do you know why we are considering the amount paid at the commencement date? It's particularly important so that we can know the entire value of the assets, the entire worth of these assets. So if you say you are paying 10,000 naira per annum, Abi, and let's say you have now paid 10,000 out of it at the commencement date, the present value we will have been for 4 years. There's a 10,000 you have paid that we also need to consider, so that the right of use asset must show the total money, the total everything you're paying, both the one you have paid and the one that is on what? Unpaid. So that when we go and look at the right of use, we must see the costs. We must see the cost, which is the entire money you would pay. So this right of use comprises the present value of unpaid and the amount paid at the commencement date. And of course, if there is any initial direct cost, we add it, which we call directly attributable costs. And of course, if there's any decommissioning cost, we also consider it. Then we add it together. This gives me my total cost. This gives me my total cost. You know what initial direct cost is? Which is like legal costs, like let's say you have to transport the asset to your location. Let's say you have to install all of that. Those are initial direct costs. Do you know what the commissioning cost is? If you have to incur costs in the future to restore the sites, to remove the assets, and you know that since that one too is a future cost, it's usually recognized at what? At present value. If I may ask you, what's the double entry for this PV of unpaid lease rental at commencement date? What's the double entry for this? What's the double entry for this? Yeah, that's correct. You are debiting right of use and crediting the what? Lease liability. That's what I told you here. Which is why it's here and it's also here too. Credits, debits. Right? For the amount paid at the commencement date, what's double entry for this? Debit right of use and credit bank. That's correct. Debit right of use and you credit what? Bank. Initial direct cost. Initial direct cost, what double entry for this? Bank. Debit right of use, credit what? Bank. The commissioning cost. Yeah, it's not revenue value. What's double entry? Debit right of use. Which liability now? You need to tell me the specific liability. No, you can't be lease liability. Thank you very much. Provisions. You credit provisions. That's what you credit. You credit provisions with the present value. Good. Now you are becoming accountants. You need to know the double entry of everything. That is what we do, accountants. Okay. So this is the initial cost of that asset. Abi? Now, what happens at the end of the year? What happens at the end of the year? Which is what we call what? Subsequent. We call it subsequent measurements at the end of the year. So, every year. At the end of every year. So, who can guess? What happens to the right of use asset at the end of the year? You depreciate it. Thank you very much. We call it what? We call it cost model. And what's the cost model? It's costs minus accumulated depreciation minus accumulated impairment losses. Thank you very much. That's the cost model. But it's possible to use the valuation model too. Even though in the exam, you just depreciate it, right? In the exam to get your carrying amount. But know that it's possible to also use the valuation model too. Especially if the asset you have leased is measured using revaluation what? Model. So it's possible to also use what? And what is the valuation amount? What's the valuation model? No. Yes, but you didn't state it properly. Yeah, you're right. Is revalued amount or fair value minus subsequent accumulated depreciation minus impairment loss. If I have time, I'm supposed to teach you depreciation and amortization. I'm supposed to revise it with you because I can see some of you have forgotten it. You find it in your exam. It will be there. How to treat depreciation, all those straight line method, all of that. I don't know. It might come out. It might come out. I don't know what will come out. So that's why we are trying to do as many. Okay. And there's a third one that you can also use, which is what? Fair value model. And this is just the fair value of the assets. When you are using fair value model, you don't depreciate the assets. It's just the fair value. And this is typical where the leased asset is an investment property. Where the leased asset is what? That is the only situation where you might have to use a fair value model. That is all for the lessee. It's very straightforward. There is really nothing there. Nothing there at all. Very straightforward. But I need to mention something which the standard called, are you with me? The standard calls it optional exemptions. Optional exemptions. Meaning that there are situations or transactions where you won't have to to follow the complete requirement of this standard. They call it optional exemption. You have to follow the complete requirement for lessee. That all you just have to do, that if you lease an asset, that all you just have to do is just to recognize the rent in P&L. As you are paying the rent, whether every month or every year, you just credit your bank and debit P&L. That you won't have to go through this stress of doing lease liability and all of that. Just expense it like normal rent, right? They call that optional exemption. So there are two optional exemptions. Number one, if it's a short-term lease, it is a short-term lease. And from the name, you would agree with me that is a lease that is less than 1 year. And two, the underlying asset is low value. The underlying asset is of low value. Of course, theoretically, they will tell you whether it's low value or not. I mean, for the fact that you're able to remember that when it is low value, you are exempted optionally. You can decide to stress yourself. Oh, it's okay. It's not mandatory, right? So those two you're exempted. Let's solve questions, please.
So,
4.3. Are you all there?
on 1st January 2002, Networth Limited bought a plant from Password Limited under lease contract. The terms of the lease requires Networth to make four annual installments of 2 million, each payable at 31st December. The present value of this lease payment is 5.7 million. The interest rate implicit in the lease is 15% per annum, and it's estimated that the plant will be economically productive for 5 years. There is an opportunity to extend the lease term at conditions favorable to net worth. The reporting date of net worth is 31st December. Required, show the financial statement extract of net worth limited over the relevant periods.
So this is a typical question. They want us to show the financial statement extracts. So when a question comes like this, that means ultimately you have to prepare a financial statement extracts. Okay, just put the relevant items there. So in this case now, it's a lease. It's a lease, and this guy, the lessee is whom we are dealing with now, who is net worth, while the other guy is the lessor, and we can see here that it's a 4 years lease, right? Because there's a 4 year instrumental payment of 2 million per annum, and it's payable at the end of every year, which is December. It's payable when? At the end of every year, which is December. That means it's possible that it might be payable at the beginning of the year or even during the year. But we expect that a normal examiner should give us either at the beginning or at the end. Abi? Also, they gave us the present value of the lease payments. Like I told you, in most questions they will give you, right? They are not really bothered about annuity factor, multiplying it by the annual payments and all of that. They are focused on the accounting. Okay? So they also gave us the discount rate 15%. They said the useful life of the asset is how many years? It's 5 years. And they also said there's an opportunity to extend the lease at a condition favorable to net worth. So with net worth extend, it will extend. Okay? So that means the lease time won't be 4 years anymore. Since they said they can extend. So extend to how many years now? To 5 years? Why can't they extend beyond that? Of course, that means it will not be useful to him after 5 years. So it's rational to assume that it will extend to what? To 5 years. Yeah, that's what it should always be. Very straightforward question. So let's quickly deal with it. So our lease liability first. Let me call this my workings. When was the commencement date of the lease? 2002. Let me call this balance brought forward at the inception of the lease. So how much is the present value of the unpaid lease rental? So at the end of the year, I said we are going to increase the lease liability with interest, reduce it with lease rentals. So let's start with the interest. Let me call it finance cost. At They give us the interest rate implicit in the lease. That's what they call it, interest rate implicit in the lease. That's the discount rate. So it's 15%. So what's 15% of 5.7 million? One, sorry? What's the addition? Then we reduce it with what? How much is the lease rent house? So we are left with how much? As my balance what? Okay, that's year one. You agree with me that if I should switch, this and this in a way that I remove my lease rentals first. If I remove my lease rentals first and I get 3.7 here, and now apply my interest of 15% on that 3.7, I won't get this. So it's particularly important that you follow this order. It's particularly important you follow this order if the lease rentals are paid at the end of each year. At the end of what? Each year. If the lease rentals are paid at the beginning of this year, you're going to flip this thing around. Lease rental will come first before finance cost. I will solve that in the next question. Okay? I will solve that in the next question, where lease rental is paid at the beginning of the year. But if the lease rental is paid at the end of each year, it has to be like this. And do you know why? The reason is because finance cost is always at the end of every year. That is when you unwind your discount. Always. Always. You unwind your discount at the end of every year. So at the end of the year, the first thing you need to know is that what is outstanding is 5.7. I applied on 5.7. Then before this guy comes and settle up 2 million, because this one now too is happening when? At the end of this year. Okay? But if it happens that we are doing this at the beginning, then we should remove this one first before we add our interest. Since interest is always occurring when? At the end of the year. Okay? But for this one, since both are happening at the end of every year, get how much you are owing first, total, plus interest, before you now remove what you want to pay. Let's know how much are we owing. So that's why we add the interest first before we remove the what? The rent. Secondly, this 4.5 million, if I may ask, is it a current or a non-current liability? This 4.5 million, is it a current liability or a non-current liability? Why?
It's going for 4 years. Like it's really it's not for the present level. It's really for subsequent. And 5 years, we'll remove 1 year of 5 years. We have 4 years. Okay. Balance carry.
What did you say? Between. That's the correct answer. It's a mixture. In fact, you have to split it. You have to. They will not forgive you at this level if you don't split it. You must split it. Because out of these amounts, there's a portion that is due next year. That one is current. And the remaining will now be what? Non-current. You will see when we are presenting our statement of financial position. I needed to mention that. So in 2003, how much are we bringing forward? How much is our finance cost? So how much is that? 6,250. When we add that, remove what? What do you have? How much is the interest? For what? Mm-hmm. Total. What's the difference? See, this should be zero. Just you can write it, you can leave it. So I'm sure it must have been this that will have cost but it should be zero. Okay, so this is the lease liability for the period. Then I need to get my what? So which is the same thing as this one, Abby? The PV of unpaid what? At when? How much? Do we have any amount paid at commencement date? We don't. Do we have any initial direct costs? Do we have any decommissioning costs? Okay. At the end of the year, we'll do our depreciation per annum. Abi? So please note, please, so right of use asset is always depreciated over the lease term. Is always depreciated over the what? In some texts, they will tell you the lower of the lease term and the useful life. I don't see a scenario where the useful life should be lower than the lease term. They usually tell you the lower of the useful life and the what? Lease term. Why would you agree a lease term that is lower than the useful life of the assets? Okay, so it's always the lease term. A reasonable question would not give you a lease term higher than the useful life of an asset. Nobody would agree to that. So it's always the lease term. In this case now, how long is the lease term we agreed? because you can extend. Can extend. Okay, so the depreciation per annum is divided by the lease term, which is how many years? So how much are we looking at per annum? Okay, so that's it. So what goes to P&L here? The finance cost. In year one is how much? In year two? In year three? In year four? Then if there's year five for depreciation, you can put. The depreciation, sorry? It should be the same thing all through. So when taxman come, they will usually, of course, disallow depreciation. They will disallow. So when I'm doing my tax computation, right? Me, I will allow depreciation on right of use. I will not claim capital allowance on it. You see, that actual rent that is not in P&L, I'll go and take it for my workings. I'll allow that one. Because I will have seen that that one pays me than if I disallow, because that lease rental is not in P&L. So there is no point saying you want to. If I disallow depreciation, I now go and take advantage of capital allowance. When I do it, it doesn't pay me. The one that pay me is that rent, gun, 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 gun. When they now come, no, disallow. You know, how can you disallow my depreciation? Go and check. Did I claim capital allowance? He said no. I will ask you not to claim. Okay, show me in the computation for capital allowance where they say leased asset. This is the rate. So which rate am I supposed to use? No, you have to do that. Okay, no problem. Some will agree. We'll move on. Some will not agree. Either way, it's a win-win. For me, most of them, they will not remember that I've allowed lease rentals. They will disallow capital allowance. Say, okay, let me claim capital allowance. I'll claim capital allowance. I'll deduct lease rental. And my company is happy. We'll pay lower tax. This is recorded. I'll delete it off. Okay. So let's go to the statement of financial position. Oh yeah, let's go to the next question, please.
A company enters into a 4-year lease commencing on 1st January 2001 and intends to use the asset for 4 years. The terms are four payments of 50,000 commencing on 1st January 2001 and annually thereafter. The interest rate implicit in the lease is 7.5%, and the present value of the lease payment is not paid at 1st January 2001. That's three payments of 50,000, discounted at the rate of 130,000 26 naira. Legal costs to set up the lease incurred by the company was 402 naira. Required: show the lease liability from 1st January 2001 to 31st December 2004 and explain the treatment of the rights of use assets.
Okay. So for this one now, we're told that okay, and he entered into a lease arrangement. So we are paying 50,000 every year for 4 years, Abi? So that means the lease time is how many years? It's 4 years. And it's commencing on 1st of January 2001 and annually thereafter. So that means we're going to be paying that 50,000 at the beginning of every year. So they gave us the interest rate implicit in the lease to be 7.5%. They gave us the discount rate to be 130,000. The present value of the unpaid lease rentals and the legal costs to be 462, and they want us to do this. Okay. So in 2001, what's the present value of unpaid lease rentals? 130. 026 or 056. So we're going to add the interest, Abi. We'll remove the lease rentals first. Since payment is made at the beginning of, and how much is the lease rentals? How much? If you have done this, you are wrong. Because in the first year, you cannot remove 50,000 again from this. Yes. Why can't I remove it? It has been paid already before we got this 130. It was paid before. So this one is unpaid lease rentals. So they didn't include 4 years payment here. It's 3 years. They won't even include the 4 years because this will have been paid at the commencement date. Okay, so you cannot remove this now. That will be double counting. So 0. So this remains my what? Then my finance costs at which rates? And how much is that? 9,000. So what's my balance carried forward? One 139,778. So in 2002, then I can then remove my 50,000 now, Abi. So what do we have? 89,778. So what's my finance cost? What's my finance cost? Sorry? 6,007. So what's my balance? 96, 96,511. And in 2003, I have 96,511. I remove my what? This will give me how much? So what's my finance cost? So it closes out. Abi? Then my right of use assets. My right of use assets. The same thing, Abi. The PV of unpaid what? How much? How much is that? What again? Which is the initial direct cost, Abi? How much? Is that all? So how much would that give us? So at the end of the year, I will have my what? Annual what? Which will be 180,428 divided by how many years? 45, 1, 45, 107. And that is that for that question. And that is that for lessee accounting. Double I's.